Hello students, today we will start a very interesting chapter on income tax, that is clubbing of income. Now what is clubbing of income? Clubbing means when the income of an assessee is actually clubbed into either with another assessee or to himself. Now generally we all know that any assessee will have to pay tax on his own income. But there are some cases or situations where, due to some legal provisions, his income will be clubbed into with someone else. Means sometimes, in some exceptional circumstances, the basic principle that he will be taxed in respect of his own income is deviated, and the assessee may be taxed in respect of income which legally belongs to somebody else. Means it is possible that the assessee will be taxed on the income which is not actually his or her, it's on someone else. Earlier, the taxpayers made an attempt to reduce the tax liability by transferring their assets in favor of their family members. So we know that somebody, if he want to avoid his tax, he will make his income or his assets with the name of maybe his daughter, his son, his retired parents, his wives. So it means the income arising from those assets will not be charged or will not be taxed in the hand of the employee. So to reduce this, the Indian government under Income Tax Act and under Finance Act gave some provisions that there will be some clubbing of income for the SEC. So it means, so to counteract with such practices of tax avoidance, necessary provisions have been incorporated in section 60 up to 64 of the Income Tax Act. Hence, a person is liable to pay tax on his own income as well as income belonging to others on fulfillment of certain conditions. Inclusion of others' incomes in the income of the assessee is called clubbing of income, and the income which is not so included is called the deemed income. So it's been clear here, the income which you have to pay tax coming from someone else or maybe his own is known as the clubbing of income, and which is not included is known as the deemed income. Now, what are the objectives of studying the clubbing of income? Now, why we will learn this, or why the government has implemented such rules? Number one, circumstances when income is some other person is included in the income of the assessee. Then the provisions when these sections will be applicable and under what head whose income will be included. So when it will happen, how it will happen, and under which head it will happen. These are the objectives. Now, there are some rules, there are some some forms or meanings. These are the transferer, the person who transfer any of his belongings, especially his assets or income to another person is known as a transferer, means who is transferring. A transferring means to whom he is transferring. The third point is very important, the revocable, the right to require or to take back anything legally which was given earlier under an agreement or settlement. Means there is a possibility of taking back the asset. When it happens, that asset is called the revocable, or the condition is called the revocable. The asset will be called as the revocable asset, and that transfer is known as the revocable transfer. I can give an example that if a person is giving his house property to his friend without any proper consideration, illegal consideration, and he said that after 3 years I will take it back. So there is no such legal rules or contract, and that asset may be taken back to to the earlier person is known as the revocable transfer. Then the minor is a person who is below the actual age of the 18. So these terms will be very important when we will learn the clubbing of income. Now, first to section 60, the transfer of income without transfer of asset. Means it is applicable if the following conditions are satisfied. Number one, the taxpayer owns an asset. Then the ownership of the asset is not transferred by him. Then the income from the asset is transferred to any person under a settlement, trust, covenant, agreement, or arrangement. And the above transfer may be revocable or may not be revocable. Means it may be possible to get back the asset or maybe not. And the above transfer may be affected at any time. Now, if the above conditions are satisfied, then income from the asset is taxable in the hands of the transferor. Means who is actually transferring the asset, not in the hand of the person who got the asset. That is the transferor. Now we can get an example that someone owns a debenture worth rupees 1 crore of ABC Limited. Interest is 1 lakh on April 1, 2005. He transferred as income, interest income to someone else, means Mayur Tafti, his friend, without transferring the ownership of these debentures. Means it's a revocable transfer. Means it's not a legal transfer. Although the interest of rupees 1 lakh is received by Mr. Mayur Tafti, it is taxable in the hands of the Darshit Parwan as per section 60. Means it is not a legal transfer. That is why who is actually the owner of the debenture, he will be pay the tax on the interest what he gets, not the person who is actually getting the interest now. Next to section 61, the revocable transfer. If an asset is transferred under a revocable transfer, income from such asset is taxable on the hands of the transferor. Again, if it's revocable transfer, the transferor will give the tax. The transferor for its purpose includes any settlement, trust, covenant, agreement, or arrangement. In any of the following cases, transfer is treated as revocable transfer. These are: number one is very clear, if the asset is transferred under a trust and it is revocable during the lifetime of the beneficiary, or if it is transferred to a person and is revocable during the lifetime of the transferee. So it can be possible. So think about from the angle of the assets point of view and from the point of view of the person. And if it is before April 1st, 1961, it is revocable within the 6 years, not beyond that. And if the transferor contains any provision to retransfer the asset to the transferee directly, indirectly, or wholly. So under these circumstances, these will be treated as the revocable transfer. Now here are some cases, very interesting cases. Number one is Mr. X transfer a house property to a trust for the benefit of A and B. However, now remember it's a trust. However, X has a right to revoke that trust during the lifetime of the A and B. That is revocable transfer, and the income arising from the house property is taxable on the hands of the X because X is the transferor. Now the second situation is Mr. X transfer a house property to Mr. A. However, X has a right to revoke once again and the transfer during the lifetime of the A. So it is once again a revocable transfer and the income arising will be taxable in the hands of the A. In the last case, X transfer an asset on March 31, 1961. So look at the date. So it is before 1963. It is revocable on or before June 1963. It is a revocable transfer and income arising from the asset is taxable in the hands of the X. Conversely, if X transfer an asset before April 1961 and it is revocable after 6 years, say it on April 10, it's an example, it is not taken as a revocable transfer. So the date is important. So you remember the previous point of the revocable transfer rules, and here the date is important. In the previous two cases, the transferor and the terms of the contract was important, and in this case, the date is important. Then some other examples. They transfer an asset under the terms of transfer on April 1, 1998. He has a right to utilize the income of the asset for his benefit. However, he has not exercised the right as yet. On April 1, 1998, income of the asset would be taxable in the hands of the X, though he has not exercised the aforesaid right. So he have not claimed it as a revocable, but still it will be taxable in the hands of the X. Next one is X transferred an asset under the terms of transfer. He has a right to use the asset for the personal benefits of his family members whenever he wants. Once again, it's a kind of revocable thing. Till date, he has not exercised it, but it is revocable transfer and the entire income from the asset would be taxable in the hands of the X. So the revocable does not mean he have to take it back. He has to take it back. If the context is right that if he is giving the asset to such person and he's telling this, I can take it back or I can take it back the income, then in both the cases it will be revocable and the income will be taxable in the hands of the transferor. Now these are the conclusions. There's an asset, maybe a revocable transfer. Income will be handled as the transferor, and such income is taxable as and when the power to revoke the arises. Now the section 64, 1 subsection 2. Now, when an individual is assessable in respect of remuneration, the taxpayer is an individual, obviously have substantial interest, and the spouse of the taxpayer is employed in the above mentioned in concern, and spouse is employed in the concern without any technical or professional knowledge or experience. So here we are talking about the spouse, means if the husband wife is there and both of them working in a in same company, then whose income will be clubbed or taxable in whose income. So that is also an interesting part of the club of income. So in the above conditions satisfied, then the salary income of the spouse will be taxable in the hands of the taxpayer. See, if the above conditions are fulfilled, but he's a substantial interest in the 1/5, he is holding 1/5 or more share, and is not without any technical or professional knowledge. It's not a CA or ICWA or means the lawyer. Then in that case, his income will be taxable in the hands of the taxpayer. So here the substantial interest has been explained that it is not less than 20% of the voting power. And relative means obviously the individual means the husband, wife, or brother or sister, not beyond that. And look at the last point, when both husband and wife have substantial interest in a concern and both are employed by the concern without professional qualification, remuneration will be included in the total income of husband or wife whose total income including such remuneration is greater. Means if both husband and wife are working in the same company without any technical knowledge, without having the substantial interest, then whose income will be higher. Suppose the wife is earning more remuneration, then in that case, husband's income will be clubbed with the wife's income. So that is the actual clubbing of spouse taxability. Then look at the example. Mr. X has a substantial interest on a limited, and Mrs. X is employed by a limited. So the situation is X is the interest holder and X is the employer. Without any technical or professional qualification to justify the remuneration, in this case, salary income of Mrs. X shall be taxable in the hands of the X. Because X is getting actually the substantial interest, means he is actually considering those features which I have told earlier. If those conditions are fulfilled, so in this case, the spouse's income of Mr. X will be clubbed with Mr. X, though the salary is getting by his wife. Now, the income from assets transferred to spouse, becomes taxable under provisions. So same, the same rules. There's an individual transfer an asset, as it transferred to his or her spouse. The transfer may be direct or indirect, and the asset is transferred without the adequate consideration, and the asset may be held by the transferee spouse in the same time or from a different form. So if the above conditions are satisfied, any income from such asset shall be deemed to be income of the taxpayer who has transferred the asset. So once again, if it is income from assets by the spouse, so it will be taxable. Who will transfer the asset means the transferor. So in every time, in most of the cases of the clubbing of income, the transferor will pay the tax. Now here is the example. The X transfers 500 debentures of IFSI to his wife without adequate consideration. Interest income on these debentures will be clubbed into the income of X because he's actually fulfilled the following conditions. Means if assets are transferred before marriage, before marriage, and if assets are transferred for adequate consideration, and if assets are transferred for connection with an agreement to live apart. And on the date of actual income, transferee is not spouse of the transferor. That's a very important point. In the date of the actual of the income, the transferee is not spouse of the transferor. And if property is acquired by the spouse out of pin money, that is an allowance given on the wife by the husband. So the aforesaid 5 cases, the income arising from transferred asset cannot be clubbed in the hands of the transferor. So in all those 5 cases, the income arising will be in the hands of the transferee. So then before marriage, adequate consideration, agreement to live apart, actual income, not the spouse, and the pin money. So these are the 5 points where the transferee will get the taxability. Now the income from assets transferred to the son's wife, the points are more or less same. The taxpayer is the individual. She transferred the asset after May 31st, 1973. The asset is transferred to son's wife. Transfer may be direct or indirect. The asset is transferred otherwise than for adequate consideration. And the asset may be held by the transferee in same form or different form. So if all these all these conditions are satisfied, the income from the asset is included in the income of the taxpayer who has transferred the asset. So here the transferor means the case if these 5 conditions are fulfilled for the son's wife. Now we are almost getting to an end. Now the income from assets transferred to a person for the benefit of the spouse. So most of the times people will do that to benefit of the spouse. So look at the conditions, almost the same. Individual, and he should transfer an asset to a person or an AOP. Transfer may be direct or indirect. Asset is transferred for the immediate or deferred benefit for his or her spouse. And the transfer of asset is without, that is the main thing, without the adequate consideration. Now, if the conditions are satisfied, then income from such asset to the extent of such benefit is taxable to the hands of the taxpayer who has transferred the assets. So once again, here the taxpayer will pay the asset. Mainly the last point is the important, the transfer of asset is without the adequate consideration. So that is why here the liability goes with the transferor, not with the transferee. So once again, the income from assets transferred to a person for the benefit of a son's wife. So it's the same points. And if the above conditions are satisfied, then income from the asset to the extent of such benefit is included in the income of the taxpayer who has transferred the asset. So once again, the son's wife on the income from the asset. So whether it's an asset or from the income of the asset, it will be the transferor who will pay the tax. And because of the last point, otherwise than for the adequate consideration. Now, what will happen if the income is from a minor child? It is very interesting. All income which arises or accrues to the minor child shall be clubbed in the income of his parent. No problem in that. Whose total income, excluding minor's income, is greater. Means his out of his parents, either his mother or father, who will get the higher income, will get the taxability, will get the power of clubbing. However, in case parents are separated, the income of minor will be included in the income of that parent who maintains the minor child on the relevant previous year. So if it is a divorce case or a separation case, then who got the child and the legal holding of the child, you have to pay the tax. When clubbed is not attracted, the following income will be taxable in the hands of the minor child. Now look at these 3 points. Income of the minor child from any sources suffering from any disability of the nature specified under section 80U, income of minor child on account of any manual work, or income of minor child on account of his activity involving an application of his skill, his talent, or his specialized knowledge or experience. Maybe he or she is a good dancer or a singer or an artist. So in those cases, the income will be clubbed with the parents. Not only that, because he is using his own talent in the following cases, it will be taxable in the hands of the minor child. So it's a very interesting case where a minor child is going to be the taxpayer. It will be taxable in the hands of the minor child. Now, what are the exemptions? It's only one exemption under section 1013(2). In case the income of an individual includes the income of his or minor child, in terms of provisions, such individual will get an exemption up to rupees 1500 in respect of each minor child. So each minor child. However, the income of any minor child so includable is less than 1500. Therefore, that exemption shall be restricted to the income so included in the total income of the individual. So his income and 1500, whichever is less. So you'll get an exemption if it is a minor child, per child it is 1500. So these are the some tax implication for the HUF. So case 1 where individual converts the 31st then his self-employed property, and in case 2 when such individual transfer his self-employed property directly or indirectly to the other family otherwise then for adequate consideration. Now, the income from acquisition of property transferred, in this case the income arising to the transferee from the property transferred is taxable in the hands of the transferor, and income arising to the transferee from the acquisition of such property or from accumulated income of such property is however not included in the total income of the transferor. So you can see the example that Mr. X is transferring his 10 lakh to his wife without the consideration. That's an important part. And she deposits the money to a bank. Interest received from the bank on such deposit is taxable in the hands of the X. If, however, his Mrs. purchases a house from the account, interest and rental income received by Mrs. X is taxable in the hands and will not be clubbed with income X. So it will be the income arising from that house will be clubbed, or the income will be taxable with the Mrs. X, not Mr. X, because Mrs. X is got that asset purchase with the income receiving from the income from the bank interest. Now the last question: can negative income be clubbed? If clubbing provisions are applicable and income from such a source is negative, it will still be clubbed on the income of the assessee. Now look at the cases. Mr. X gives Mr. X 2 lakhs from the which he starts a business. Now, as per clubbing provisions, whatever is the profit from his business, it will be taxable in the hands of X. Okay. Since it is an income taxable under the profits and gains of the business and profession, we all know, that is why it will be taxable under the same head, and income will be calculated as if it is the business of Mr. X. So obviously, so Mr. X gives Mr. Hugs and which he starts a business, so it will be treated as business of Mr. X under the head business and profession. And if minor son Y has a business, and another case for the previous year 14-15, loss from business is 20,000. Okay, and the loss of 20,000 will be included in the income of Y of Mrs. Y or Mrs. Y, whosoever income has the higher income. Very interesting case. So if the minor child is earning something out of the parents whose income is higher will be clubbed into with him or her, and once again if it's a loss, once again the same, who has the higher income, it will be clubbed with to whom. So hope you have understood the clubbing of income a bit. So if it will be easier for you if we go through the video again and do some problems. So for then, bye bye.